Ahoy there, trader, and welcome back. This is the Anti-Investor Trading Podcast. So let's talk about risk management in trading and the key to preserving capital. Yes, it's that boring subject. Unfortunately, it's also very important. So let's dive right in. So welcome to the Anti-Investor Swing Trading Podcast, where we talk about stock options, index futures, occasionally a little bit of day trading as I get back to my roots. My goal is ultimately to give you the right tools, the correct rules, software to assist you, a community to support you, and if you will allow me to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. So with that out the way, let's look at risk even. I've got my Sean Connery teeth in. My risk management is critical to long-term success, any success with trading. And basically, don't bet the farm. It can be summed up very, very easily. It can be said as a throwaway comment, but it's mostly overlooked, especially by new traders, and it is a critical part of trading. Now, some considerations to look at for for risk management is capital preservation. Basically, don't bet the farm. Don't lose it all. Limit your losses. Again, whimsically, these things can be summed up very, very quickly, but we want to think about how to actually implement these things. So limit your losses and maintain sufficient funds to trade in the future. So basically, I want to be able to trade today, tomorrow, next week, next month, next year, and not worry about what happened yesterday. So your position size needs to reflect that possibility. So trade small is the bottom line here. Again, I've spoken many, many times about this. Think about your number. What's your number? It might not necessarily be 1%, 2%, 3%, 5%, 6%, which is what the textbooks say, but think about what your number is, your per trade risk. What are you comfortable with? If you have a string of losses, which all systems will incur from time to time, along with a string of wins, but if you hit that losing streak that all strategies have, can you weather that storm? Can you handle it both practically and emotionally? And if you can't, then your position size is too big. So think about your number. Similarly, you want to think about your emotional bank balance. Can you emotionally handle 10 monetary losses, not losing trades, because if you follow your process, it's got to be a winner. But if you have monetary losses, 10 of them, just for example, back to back to back, can you handle that emotionally? And if not, well, guess what? Your position size is, for the moment, too big for your emotional capabilities. And your emotional bank balance is never spoken about in any textbooks. So think about it in those contexts. Practically and emotionally, can you handle a loss or several losses for that matter? Now, when you do that, it's going to help you apply consistency. We've spoken about this at length. Consistency in trading, your performance, if you've got a systematic approach to find, filter and sort opportunities like what I have, then you should be able to backtest it. You've got this historical expectation as your benchmark. So are you over the benchmark? Are you under the benchmark? If you're under the benchmark, are you applying the strategy? If you're over the benchmark, why? Are the markets exceptional at the moment? But you basically want to be tracking and monitoring your performance with the expectation when you've got a system, so that you've got consistency, so that you've got that average expectation that you're looking for, and you avoid large drawdowns from the make it up as you go along method. Now, some reasons why you might, or new traders might overlook the risk management is just misunderstanding the market volatility. Not knowing that your 1 point stop loss is going to be wiped out quite quickly in the current market environment, because an average movement on the time frame that you're looking at might be 5 points, 5 times what your stop loss is. So of course you're going to be stopped out several times, very, very quick in fact. So I tend to use a price volatility stop loss if I'm using them, which uses ATR, the average range of movements on the time frame that I'm looking at, and that gives you this flexible risk control on your individual trades that move with price volatility. Now, other things may be overconfidence, especially early on. You've seen a few trades, you've watched the markets for a bit, you've got what you think is a strategy, and you're eager, anxious, perhaps even a little bit overconfident. In the early stages of your trading, you may even hit some beginner's luck. And again, luck can be a huge part of it. We'll probably talk about that separately on its own show because it can be quite fun to explore. But you can be overconfident as a result of some beginner's luck. And maybe you've hit the other side of the spectrum. You've got lack of awareness about the importance of risk. And again, you go and push all your chips on the table. You have one huge wipeout. Other elements of lack of awareness may be that you end up watching winners and trading losses. That can be interesting to say the least. What do I mean by that? So you're watching the winning phase of your trade. You watch a winner, you watch a winner, you watch a winner, you watch a winner, you watch a winner. You go, my gosh, this is a damn good strategy. I think I'll push all my chips on the table and go for this one. And inevitably, because you've got this bias, because you've a recency bias, essentially, you push all your chips on the table on the one trade that starts the losses. And what ended up happening is you end up watching the winners and trade the losses. And you think, I must have done something wrong. So you stop trading, or after that one loss or two or three losses, and you've traded the loss phase of the cycle. And then you watch the winners to build your confidence back up again. You watch the winner, you watch the winner, you watch the winner. And then inevitably you go, right, it wasn't just a temporary blip, and you jump into the loss cycle and you end up watching winners and trading losers. And you think, this is rubbish, it doesn't work. And then you go and start indicator hopping, and you do or system hopping, and you do the same thing again and again and again. So you jump from chart to chart, indicator to indicator, time frame to time frame, watching winners and trading losses, because you've got this lack of awareness of how your strategy works. And ultimately, you can watch your account blow up very, very quickly. Now, what you also need to do is think about leverage. I'm not saying that you should use leverage, but you can have leverage. And what I mean by that is, don't bet the farm. Use leverage as a discount. So most brokers offer some sort of margin facility. And what that might mean is it depends on what market you're trading, what broker you're using. You might have 4-to-1 leverage, you might have 10-to-1 leverage, and back in my Forex days, you could have up to 200 or even 500% leverage on the funds that you have. So let's just keep it simple, 10x. So if you've got $10,000 in your account and you've got 10x leverage, you've not got $100,000. That's what leverage is. You've got 10 times the leverage. But what some new traders may do is think, yes, I've got 10 times the funds available because you've got essentially a line of credit from your broker. But the reality is you've not physically got $100,000. So you can't trade $100,000 accounts because you've only really got $10,000. So the best way to think about it is you've got a discount on the trade. So if you've got 10 times leverage, you've got $10,000, you've got 10 times less money required for the position that you need. So you can trade a little bit more actively. You can maybe have a few more positions for the risk that you want to have per trade. So the best way of thinking about leverage and its implications is use it as a discount on the trade rather than as a multiplier. Because again, you don't have that money, so you can't trade that money. So think about it as a discount. Let's also look at stop loss orders and position sizing. Again, whereas we don't bet the farm, we also don't want to lose the farm. So if you're trading a market or a strategy that requires a stop loss, again, what I mean by that is I trade options, and I typically, when I'm a buyer of options, I typically use the full price to premium in the majority of cases as a built-in stop loss. So I don't need to have a hard stop loss with that style of swing trading that I like to use. But if you're trading stock, futures, Forex, anything else that requires stop loss, or a hard exit, then you need to use it. What you can do, and new traders especially, is have these mental stop losses because you're afraid of your stop loss being hit. Well, make your stop loss wider and trade smaller position size is the simple solution. Don't trade a 1-point stop loss in a 5-point ATR time frame, like what we said earlier. So have a realistic stop loss, make it wider, and trade smaller position size so that, if you're worried about your stop loss being hit, then it's too close, or you're not sure of where it should be in the first place. So make it wider, and trade smaller position size, and basically don't lose the form. Don't have a mental stop loss either. I've seen far too many traders have a situation where the market jumps against them, and that they say it'll come back, and that one trade, even with sensible position size, can end up losing them many multiples of what they were originally, or even just wipe them out because the market moves so fast, and they hoping and praying and wishing that it's going to come back, and it never does. So know when you're getting out is the point, both on a stop loss and target. The target side, again, another thing, know when you're going to exit. If things are going right, don't hope that it's going to go on and on and on and never come back. Real traders don't diamond hands. We don't shoot for the moon. If you're day trading, what's a typical day look like on the chart that you're trading on, the S&P futures, on index futures, on the Dow, whatever it is that you're trading on, Apple stock. If you're day trading, what's a typical move look like in the morning? What's a typical move look like for the day? If it's done an average day's move, why are you trading? What is the expectation that it will move further? If it's done what it does typically on average, why? And if you're in the trade, think about taking some profits, closing, tightening your stop loss up, protecting what you've gained if it's done what it typically does on average. It's a simple thing. It's the same for the day, the week, the month. What's it normally do? All right, it's done what it normally does. Maybe I just take the rest of the day off. Maybe I take the rest of the week off. You may have other opportunities, but the reality is it's done what it normally does. Don't worry about it. Now, in fairness, with my new SPX strategy, I don't need to worry about it. It's more of an income style trade, so I don't need to worry about being right on direction. I just want it to not go against me. So just knowing the strategy and how it's going to be impacted by the market movements or lack of them thereof is important. Again, the style of day trading that I'm favouring at the moment is using 0-day options and taking advantage of the fact that I don't need to be right on direction. As long as it doesn't go against my trade idea, it could flatline and I'll still be on for a maximum gain. Anyway, sidebar, we'll talk about that more in the future. So some non-conventional things to consider. Behavioral analysis, if I can say that with my false teeth. Understand your trading psychology. Again, last time we spoke about such things, I suggested even keep a diary of your emotional state of mind to help making, firstly, practical mistakes by following the trade, but also emotional reactions to trade situations. If you're watching winners and trading losses, you'll start to notice that very, very quickly. You watched it, traded the loss. Well, if you looked at all those trades and you monitor that strategy with consistency, you'll have the confidence to say, well, actually, it was just a blip, and I just poorly timed when I went live with the trade, for want of a better description. Another thing is don't place yesterday's trade today. Just because there was a good recency bias is essentially another thing that I'm talking about. But don't trade yesterday's trade today. Just because yesterday was a 1,000-point move on the back of some unexpected news, it doesn't mean today's going to be a 1,000-point move because yesterday was. Again, look at what's it do on average. Of course, there's going to be anomalies. There's going to be extremes, both expansion and contractionary extremes. You're going to see 10 times the normal move. You're going to see 10 times not the normal move, where price just meanders sideways. Again, we've just had a long weekend. Globex futures were open, although the markets weren't typically open. You saw this completely compressed trading activity. You could have traded, but there was just no movements. So there's no volume because the main markets were closed. So just understand what's going on. So to help with this, your behavior, if you're in a bit of a pickle, for want of a better description, let's think about 3 questions. Is it me? Is it something I'm doing? If you're tracking these things, you'll be able to do it. Is it the strategy? Again, because you're tracking and monitoring your trading with what you're expected to do, you'll be able to say yay or nay. So is it me? Is it the markets? Is it the strategy? So the last one, is it me? Is it the strategy? Is it the markets? So is it the market conditions? Again, if markets do what it typically does on average on a regular basis, then it may be just a bit of a sticky phase of the markets. If you're doing everything you're supposed to be doing, how can you be in a losing situation from an emotional point of view, a practical point of view? It's just part of the drawdown phase of the strategy. And if that's disconcerting, if that's uncomfortable, then probably your position size is too big. So you need to go back to that. And then is it the markets? Again, is there anything weird going on, essentially? Is there anything weird going on? Again, you can look at VIX to help with that. If VIX is spiking, and you probably already have seen that the markets are doing more than they typically do on an average day on a regular basis. And you'll probably see something in the news headlines as well with that situation. Again, 2020 springs to mind. Something weird was going on then. The markets were very weird for an extended period of time. So just keep that in mind, and maybe you need to widen stop losses or reduce your position size, or just step away from the markets if you're not sure what's going on. And it's okay to do that if you're not sure what's going on. Also, let's think about stress management. Again, we spoke about this previously on a previous episode. Think about meditation. Think about going for walks. I mean, yesterday, so long weekend, Monday was off. Tuesday for me is yesterday as I'm recording this, if you listen to this in the future. So Tuesday, I actually went hiking. Just because the markets are open doesn't mean that I need to trade. So I went hiking, I did stuff. There was I just wanted the extra day on an already long weekend. So you don't need to trade if you feel like you want to go and enjoy yourself. Go hike, go meditate, and go to the gym, go and spend time with loved ones. Maybe you've got the day job to consider. Maybe you don't need to trade every day or every week. If you've got other things going on. So just take a break and restart the following Monday. Again, I've got a little bit of a mental hitch when it comes to this. I don't like stopping and starting in the middle of the day or the week or whatever. So if I've taken an extra day or two off, or something's occurred, I'll probably just take the rest of the week off and restart on the Monday. Just mentally, that just gives me a little checkbox that satisfies those things that kind of frustrate and bug me. Lastly, let's think about scenario analysis. If you're prepared for the possibility, so what's the military thing there? So prior planning prevents piss poor performance. So what if scenarios are really good for this? The market can only go three ways. It can go up, down, or sideways. And if you can plan for the possibility, well, what if the market did crash? What would be your emergency handbrake, if you like, to trigger you to step away and just reevaluate? And conversely, what would cause you to press the accelerator on your trading if the markets were going great? Think about these scenarios. Of extreme, so that you're not left flapping, wondering what to do when something weird happens. Use your observations in the markets. Go back and study the market crashes, the corrections. Again, you've heard me speak about them before. Corrections, for example, they happen. A correction will be 10% in 10 days, just to quantify it, minimum, no more than 20%. But you can see corrective moves happen in the markets once, twice a year. There's a season for it: February, March, September, October. Right now as I'm recording this, it comes to the 21st of February. So I'm expecting a corrective move in the markets. Will it happen? Well, we didn't have it last year. It's okay for it to skip a year, but I'm expecting it this year. So I'm in that season for a corrective movement. So I'm anticipating a fast bearish movement, and I've got a plan of action ready for when those conditions are met, and I can deploy a temporary strategy that will allow me, hopefully, to participate in the glorious bear movements that we're expecting. But it's one of those once a year or every other year situations. Now, similarly with crashes, they typically happen around the same time, surprise surprise, and about every 10 years on average. So we've just had one, 2020, and again, if you listen to this in the future, it's 2024. So we're not due. It doesn't mean one can't happen, but we're not due for one for a while. The markets are not there yet for such a huge crash, but they typically happen with that type of frequency. And if you're aware of these scenarios, then you can be prepared for the possibility that something funky may, or more than likely, it probably won't happen. And all these fears and worries that people have with the markets, they don't normally come to fruition with the degree that they happen. So I suppose that on that note, turn the news off. The talking heads, the media, they're always talking doom and gloom. If it bleeds, it leads. So you're always going to be worried about the extremes, and they don't happen with that degree of frequency. Lastly, rules remove discretion. Rules remove discretion. So have rules. Again, I like systematic approaches to find, filter, and sort all my opportunities, whether I'm day trading, income trading, swing trading, overnight. I've got a variety of different strategies that I like to deploy, and having rules for them means that I can, like a pilot has a pre-flight checklist, check, these conditions are met, put the trade on. And that's how I like to trade it. It just frees up my emotional state of mind. Right, we are there. Let's try and land this plane. So risk management and trading, as you probably gathered, it's not just about setting stop loss, having small position size, and managing those positions. There is a deeper understanding that is involved about the market dynamics. That comes with time and experience, but if you just apply some of the early comments, you'll by default be taking them into consideration for most scenarios. And then when you've got a little bit more market experience, you can look at the dynamics. You can start looking at your personal trading psychology and putting a plan of action in for your success, and incorporating these practices for long-term mental well-being and physical well-being. So by addressing all of these aspects, you can have a robust risk management strategy that safeguards your capital and sustains your trading career over the long term. Right, so if you like what you've heard here today, be sure to follow and listen. Also, take a look at the very first episode where I map out one of my 6 money-making strategies. It's a trend trading strategy that I use for swing trading. You can use it for the shorter time frames as well. And I will more than likely be covering my income strategy at some undetermined point in the future. However, if you can't wait for the income strategy, you can go and check out my website, antivestor.com. There's a link in the description. But that's it for now. Thank you for your time today. Thank you for giving me your time and attention and making me part of your regular routine. That's all for now. Have a wonderful day. Have a great trading week, and I'll speak to you at the same time next time. Toodaloo Trader. Keep in mind that futures, options on futures, stocks and stock option trading involve a degree of risk that may not be suitable for all investors. There is a risk of loss in every investment that you make, and it's your responsibility to assess the risks of your decisions. Past performance is no guarantee of future performance, and Antivestor provides educational information and does not provide financial advice.